All right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your host, Thomas Kopelman, and here with me today is Matthias Smith. I'd say this all the time, but if you follow me on Twitter, you probably will see every single person that I bring on this podcast, and that's how we got connected. So, thanks for joining me today, man. Before we dive into it, will you just give everybody a quick overview of who you are, what you do, and then that'll segue right into the topic of talking about SBA loans?
Yeah, absolutely. First and foremost, Thomas, thanks for having me on. Great to be here with you. So my name is Matthias Smith. I'm the founder and owner of an SBA-focused commercial loan brokerage firm called Pioneer Capital Advisory that I started back in May of 2022, so just over 3 years ago. So it's a team of myself and then six other people. And essentially what we do is we help business buyers, both current owners that might be looking to do add-on acquisitions and or first-time buyers with navigating through the SBA 7A financing process. So essentially, the problem that we solve for business buyers is determining first and foremost, is the business that they're looking to purchase ultimately SBA eligible, and then figuring out which lenders or banks are the right ones to put the deal in front of, and helping the buyer go from start to finish through the entire financing process.
Love it, love it. So we're going to talk about all that, and I think almost best place to start here is before we even get into just SBA loans is like, so I'm somebody, my goal is I'm going to go buy a business. What are all my different loan options available?
There are lots of different ones out there. So one is you could go to a local community bank down the street. So you being based in Indianapolis, Thomas, some of these banks based on your liquidity, personal financial statement, the industry of the business, if it's something that is very asset intensive, like a manufacturing company or distribution business, they might contemplate giving you a conventional loan. So maybe you put down 20%, you get a term or amortization, perhaps in like the 5 to 7 year range, plus minus depending on the bank. Sometimes, if you have a seller that isn't familiar with the bank financing process and or a seller that just doesn't really want to go through a whole forensic accounting of their business, sometimes they'll allow what's called a seller financing arrangement. So a former prospect that I was talking with actually pinged me on LinkedIn over the weekend and said they were working on going through the SBA financing process. The seller basically was just saying, hey, this is taking too long. They pulled the bank out of the equation. They decided to seller finance the whole deal. That's more rare than typical. But to your question, what I see as the most common option, at least for first-time buyers buying companies up to about $8 million, give or take, from a purchase price standpoint, is many of them will pursue SBA financing, and that's where we come into the equation.
Okay, so it's basically conventional loan, typical from the bank. I very rarely see these unless you're right. Like maybe you're super wealthy and they're like, okay, well, hey, pledge your personal assets. If everything goes wrong, we know you're fine. But in general, most banks aren't going to underwrite such large amounts for risky businesses. You go seller financing, which I think is kind of like the dream for a lot of people. They're like, this seems easy. We can negotiate a pretty good rate, keep banks out of it. Obviously, for some business owners, they're cool selling it that way and receiving kind of almost like a pension or annuity over a period of time. And then kind of all the rest falls into the SBA side of things, which is kind of the vast majority. So describe a little bit about what an SBA loan really is, and then kind of go into industries and things that it can be used for.
Yeah, of course. So from a high level, an SBA loan is a commercial loan originated by a bank. There are some, I think it's around 13 non-bank financial institutions that are not backed by the FDIC, but they do SBA loans. And essentially, the way I kind of think about the SBA in this situation is equivalent to almost an insurance company of sorts, where the SBA, the Small Business Administration, is insuring typically 75% or three quarters of whatever the end loan amount is. And conceptually, the way it works is say you're taking out $1 million loan to go buy a business. The SBA is backstopping 75% of the credit risk for the bank. So the bank is only taking on 25% of the credit risk. And the idea conceptually is the bank is providing loans, or banks plural, that they would not otherwise facilitate if there was not the backing of the US government. And so the beauty of this for the buyer is that you can get access to capital that you typically can't through a traditional bank. Get back to the earlier discussion point. But additionally, you can get a longer term in amortization. So if you're buying a business with no commercial real estate, it's always going to be a 10-year term in amortization. If there's real estate in the acquisition, and if that real estate's at least 51% of the whole budget, so say the whole budget is $1 million, if the real estate's at least $510,000, automatically you get a 25-year term in amortization. If it's somewhere below 51%, it's going to be a weighted average formula, somewhere between 10 and 25, depending on how the math shakes out. And then the other beauty of this is that the down payment requirement is typically lower. So the SBA requires what's called a 10% equity injection. Equity just means essentially down payment, kept synonymous with that. Most of the time, people bring 10% cash to the deal from a combination of themselves and or investors. Sometimes if you get lucky, and this is more rare than common at least these days with how competitive the space has become, is some sellers will provide what's called a full standby seller's note, where effectively a portion of the purchase price is getting held back as a note that's just accruing interest until the SBA loan's paid off, at which time you can start making payments on it. And that can count for up to half of the 10% down payment.
So in general, the more real estate, the lower down payment, the longer type of the loan it can be, because they feel like that's a pretty safe, stable asset compared to the business that could be managed terribly and implode.
So not necessarily the more real estate. I'd say the lower the multiple for the business, like the multiple of earnings, the lesser the down payment, because the more loan it can support and the less equity it needs.
I see. So more like tech firm with low profit, very high valuation. That's where this is looking at.
Yeah, if you're buying like a tech firm, high valuation, you're gonna have to bring more equity to the deal because it won't support as much SBA loan.
That makes sense. Okay, so what are the most common industries where you're seeing people use SBA loans?
So some of the most common industries I'd say are like the home service companies, plumbing, HVAC, electrical, things like that. Before the whole kind of tariff situation back in the spring, lots of e-commerce was pretty popular, specifically the Fulfilled by Amazon. Those have kind of trickled back a little bit, especially with the whole like China situation, not really knowing what's going to happen there.
Yeah.
Aside from that, it's all different things. I worked with a guy that bought a company that did it was basically consulting for real estate developers that needed to relocate tortoises when they were buying properties in the Southeast. So super niche stuff. I worked with people that bought like commercial roofing before, landscaping, lots of those types of things. Basically, the way to kind of think about it is like anything that does not involve gambling, marijuana, or prostitution is SBA eligible. And then from there, it's like what the banks will finance. What I tell people is, lots of the boring businesses, things that you kind of like when you're driving down the road, you see like you see like a van or a truck for those types of businesses. Lots of those are perfect candidates for SBA financing, typically.
And that's where we all see on social media the Harvard MBA grad that's leaving private equity and they're going to take an SBA loan and buy these manual labor type companies. Pretty common.
Right. Yep. That's the same ones that are fun to meme about. Yeah.
Exactly. Okay. So let's talk a little bit about the process, because I think people have somewhat unreal expectations where you kind of just go to a bank, here's the great business, they're like, great, here's the money, let me loan it to you, which kind of surprising to me that people are surprised by it, just in general of how rigorous even just like a mortgage is. Like going through that process, you need so much information, and this is even significantly higher risk, right? Because your house, you're probably not going to destroy it, and if you do, it's something that's probably insured. With your business, you could easily destroy it, right? You could lose clients, you could lose reputation, you could, mismanage it, XYZ. So let's go through kind of what that process looks like. So somebody comes to you and says, hey, I need to get an SBA loan. What are the steps?
Yeah, so assuming they have the company under signed letter of intent, like they have an accepted offer basically to buy the business, the first step in our process, and again, this is going to be different if you're coming to like a firm like Pioneer, which is a loan brokerage company, versus if you're going to a bank, some variance. the first step in our process would kick off with the engagement letter that basically explains, we're going to work with the client to help them run a competitive SBA process. We're going to build them a deck, source and use, cash flow analysis, all that good stuff. Once the engagement letter gets signed, we then send them an intake list of what we need to basically build our deck. So business financials, tax returns, interims, personal financial statement, resume, all that good stuff. Once we have that, we build the cash flow deck from one of the analysts on our team. That then gets pitched to banks to get term sheets. Then the client decides which term sheet they ultimately want to engage. And at that point, that's really the trigger inflection point of kicking off the financing process. And so the underwriting process specifically, kind of gearing in there, that's basically the bank digging in on, how is the buyer thinking about this business? So business plan, projection, what does the current management team or kind of human capital employee infrastructure look like at this business? What's the seller doing in this company? If you pull the seller out of the business, are you going to have to hire one or more people to replace what it is that they do? Is there someone in the business or multiple people that can step up and absorb the roles of the seller? Perhaps the seller is in a sales role. Are you going to hire a salesperson? Are you going to outsource that? What's the game plan there? Are they involved given vendor, customer relationships, things of that nature? So underwriting is basically understanding financials of the business. Is the proposed financing structure going to work based on the historical financials and the projection? How is the buyer thinking about operating this company? Is this someone that has the liquidity and experience to actually take down this acquisition? Things of that nature. Then just kind of boiling things down, Thomas. Best case scenarios, you get to an approval. Generally, that's going to be about 3 weeks out, give or take, based on the bank and complexity of the deal. And at that specific point, that's when the closing post-approval process kicks off. And that's basically going to be getting down the purchase agreement between the buyer and the seller attorneys, typically, lease agreement documentation, landlord agreement, anything that's not done with corporate documentation, business insurance, life insurance, all of those odds and ends. And so generally the process, I'd say, shakes out to be about 10 weeks, give or take, with some nuance depending on, one, how well done is the business plan, how quickly does the purchase agreement get done, are the attorneys on both buyer and seller sides pretty amicable to work with, things of that nature, if that helps.
Super helpful. I think there's a bunch of different parts that we need to dig into there. So like that after, the due diligence part is kind of the way that I would describe it, where they go through like, hey, are you losing a key person? Can somebody fill into it? You build in the loan. What does the profit look like? All that. Like, that's like the traditional financial planning that hopefully this business owner has done, right? I think I've talked through with some clients who are like employees, they're thinking about doing it. They give me a P&L and I'm like, have you thought through all of those different scenarios, right? Like, to be a business owner, you have to do that. You have to think about revenue minus expenses equals profit. You need to build in all of those different scenarios and you need to be realistic, right? You need to look at, hey, okay, if we add these expenses, what does profit look like? After we add the loan, we have to think about, hey, if we lose X amount of sales because this is a relationship business and that's fair to expect in those first couple of years. Like, those are all the basics of just being a good business owner, that before you buy any business, you need to understand the impact of all of it. Do you feel like when you go through this process, a lot of the business owners have kind of done some of that homework themselves, or are you somewhat surprised in the amount of people who are like, looks like good financials, let's get an SBA loan, but they haven't thought through everything?
I would say it's kind of split into two different camps. So camp one, I would say, is people where, they have a background kind of in management or quasi-management. They've been like a team lead of sorts at their company. They've thought deeply about the business plan, all those things, and they're thinking ahead as you kind of described, Thomas. I would say camp number two is kind of what I would call like more of the dreamer types, where they understand the potential of the business. They don't have the management experience, and they're looking at it more from a financial model standpoint than actually what it's going to take to get in and operate the company. And like kind of looking back at deals of close, you can see a correlation between people where they're doing it on acquisitions and things are going very well versus people where you hear about on Twitter that they're struggling and things aren't going so well.
That makes sense to me. Okay, so a couple other things that you hit on here too. You talked about, you mentioned personal guarantees. You've talked about life insurance. So when you get an SBA loan, let's talk about life insurance, and then after that, let's talk a little bit about potentially personal guarantees on your house.
Yeah, so life insurance, so basically, and I have to go back just to triple check the current SBA guideline, but more or less, most of the time, so the way to think about life insurance as a business buyer is you're typically the key person or operator of the business. So say you, Thomas, are going to buy a wealth management firm, if you kick the bucket, unless you have the right human capital infrastructure management team in place, it's not going to run at the same state it was while you're alive, unfortunately. And so the bank requires typically getting a life insurance policy for the term of the SBA loan, which is generally 10 years if there's no commercial real estate being purchased, for the amount of the SBA loan being taken out.
Yep.
And the bank will take what's called collateral assignment on you, or sorry, on the policy, such that if you pass away, God forbid, while the loan's outstanding, whatever the outstanding balance of the SBA loan gets knocked out with the policy, and then the variance or the difference goes to your beneficiary, whoever you have what's in the policy.
Yeah, it makes sense. That's what I see all the time, and it's just something that people didn't know about going into it. So I wanted to highlight it. Let's talk about personal guarantees of your house.
Yeah, so personal guarantee kind of super high level. What it is in substance is the you as a buyer, if you're an applicant for the SBA loan, and if you have 20% or more ownership in the business you're buying, the SBA requires that you have to personally guarantee and have recourse on the SBA loan for up to the full loan note. So what does that mean? So if you're buying a HVAC company, roofing company, taking a $2 million SBA loan, if things do not go as they should, the bank can effectively, and the SBA collectively, can chase after you for up to $2 million at the very end of the sequence of events. And so as it pertains specifically to your house, if you own a piece of property that has 25% or more equity based on fair market or appraised value at the time that you apply for the SBA loan, the SBA looks at it and they basically say, you have to have a lien pledge on this property. Now, if it's below 25%, there's bank discretion or SBA lender discretion. I shouldn't group all of the SBA lenders into the bank category, even though most fall there. And so basically the bank could, if they have a lien on your house, if you default an SBA loan, they could pursue a foreclosure scenario and basically you lose your house.
Yeah, this is also one that I think people don't think about. And this is why you have to be smart in the business you buy, right? Like if you're just swinging for the fences and you go for this really high risk business and take a large loan, you do have the risk of losing your house. So like understand this is pretty common for every SBA loan I've seen, the life insurance and their house being pledged was part of it. I'm curious from your side, what happens for somebody that does not have equity in a house? They don't own a house, they rent, et cetera. Are they less likely to get the loan, or do they typically have to pledge something else?
Yeah, great question there. So if you don't own a house, so like with most of the banks that I work with or that we work with the Pioneer, they're focused primarily on one, cash flow. So based on the structure that you're looking to purchase the business with, how much free cash flow is there after SBA loan payments and seller note payments. And then they're also focused on transferable experience coupled with personal financial statement. The collateral is very much a lesser extent. So any SBA loan requires your personal guarantee and also lien on the assets of the company that you're buying, in addition to typically life insurance. But back to your question, I've worked on plenty of deals where the person that's the buyer does not own any real estate, and that's made a negligible difference to anything whatsoever. In fact, it actually makes it easier because one, it keeps the closing costs down since you don't have to get appraisal, title work, things of that nature, and it makes the process go faster, and the bank doesn't have to deal with the whole equity calculation with your real estate as they would if you had a house.
Okay. Interesting. Okay, what are maybe some of the most common misconceptions or maybe mistakes you see in around SBA loans?
Yeah, so one I would say is like the process takes forever. So I've had people reach out to me via email, Twitter DM, or X as they call it now, LinkedIn, and they want to do an SBA deal, but the broker is concerned on the sell side that it's going to take 6 months or longer to get done. Sometimes what ultimately happens is the bank that has worked a deal before that a sell side broker has been involved in didn't really know what they were doing, and things just kind of putts out. And so I'd say that's one misconception for sure. I'd say another is that it's kind of the option of last resort. So, if you have a very strong personal financial statement, let's say you have tens of millions of dollars of net worth, you could presumably go to a conventional bank down the street, using that analogy, and they might do financing for you. But there are lots of people where they have upper six-figure, seven-figure net worth, and while technically maybe you could try going knocking on the doors of conventional banks, you can get the low down payment, long amortization with an SBA bank. And so that can make it very attractive relative to getting a truncated 5-year amortization or 7-year. So I'd say those are two things. The third thing I would say, and this kind of weaves back to Pioneer, not to give a sales pitch here, is that all lenders are created equally, which I found to very much not be the case. There are banks that are truly cash flow lenders that understand the process, the program, and just the business acquisition dimension of doing one of these. And then there are banks where, back to your comment about the houses, they really lean into having a tangible asset to back part of it. And if you go over a certain amount that's not backed by collateral, it could be $2 to $2.5 million of unsecured financing is what some banks call it. They start to get kind of queasy about the deal, and it just becomes more difficult to work with them.
Interesting. So do you recommend for people who are like, hey, because there's the camp of like, oh, this business came available. Like me, I'm a financial advisor. Somebody reached out to me saying they want to sell theirs. It makes sense. Great. Now I'm going to go figure out a loan. So there's that. But then there's I'm for sure buying a business at some point in my life. Like I'm already looking, it's going to be this year or next year. When you're going through, when that's your mindset, should you try to go start talking to somebody like you way ahead of finding that ideal business? Or is it like you just can't really do much until you have that right business in front of you?
It kind of depends. So if you're someone where you're kind of serious about wanting to go down this path, you've put together a personal financial statement, you have an up-to-date resume, and you know what you want as far as like the industry or kind of type of business you want to pursue. Maybe it's a boring business, maybe it's a professional services company, and you know what you want and kind of size, things like that. Then I would say it makes sense to talk to someone like myself, a Live Oak Bank or kind of comparable, to get a pre-approval or pre-qualification. What we do at Pioneer is we'll put together what's called financial letter of support. And our specific requirements are 680 credit score, resumes showing management experience and or profit and loss kind of oversight experience, in addition to at least $100,000 of taxable stocks and or savings, just to kind of have some strength and breadth to the personal financial statement, which honestly isn't a super high bar relative to what some lenders want to see. But back to your question, if someone's able to put that together for us and we hop on a Zoom or a Teams call and meet them, they seem like they kind of understand what they're doing, then we'll put something together for them. But I would say some of the banks out there, it's kind of this whole chicken and egg thing, right? Where the bank wants to see the deal that they're going to finance you for as a buyer, but the sell side broker or the seller, if it's an off market deal, which are kind of more rare to come by, they want to see something from a bank. And so then you get into one of these kind of Mexican standoffs of sorts, if you will. And so that's where that's kind of the birth or impetus of doing these financial letters of support.
Yeah, that makes sense. So I think the tangible takeaway for people is like, hey, if you know that you're going to buy a business, you know you want to go the SBA loan route. One is like, this is a couple years away. You might want to think about, hey, do I slow 401k or Roth IRA, et cetera? I need to build taxable investments, or I'm sure cash would count. You need that liquidity side. That makes it look good. Update your resume. That's one I would not have thought about. I mean, a lot of times we're like, I'm a business owner. Like, why do I have a resume? I don't need one. I'm not going to be hired. But you almost in a way are doing it here, and just start to think about, all of the things that you would want to prepare for. And you should kind of always yearly have a personal financial statement overview of, assets minus liabilities equals your net worth. And so like by getting all of those prepped, once the right thing comes, you're ready to go. You don't have to spend all this time getting kind of caught up.
Yeah. And on the resume kind of comment there, I would say mostly for like first time buyers, kind of back to the MBA profile or someone working corporate America, lots of business owners, like more often than not, someone's LinkedIn that's pretty detailed can suffice for a resume. And the bank or lender can just extract the PDF of the LinkedIn. So I'd say don't get too fixated there if you're a current business owner.
That makes a lot of sense. Okay, cool. Anything else that we need to kind of talk about or hit on as it relates to SBA loans?
Nothing really kind of major. The only thing I would say is, if you're talking with a bank, is to look to see if they're preferred lender. If they're not preferred lender, there's also an updated list that the SBA has on their website where you can see how many loans different banks have done and what size loan kind of on average. And the big thing I would say there, Kevin, from a takeaway standpoint, is the further down that list you go, the more inconsistencies that you'll get as far as process and what to expect from the bank. And so when we look to work with specific banks, that's the thing that we really try to vet out as much as we can to figure out what to expect from a process standpoint with underwriting and closing.
That makes sense. Okay, cool, man. Well, really appreciate you hopping on and walking through all this. It's a topic I needed to talk about. But before we wrap up, let everybody know kind of best places to follow you and reach out to you if they're going to, end up going through this process.
Yeah, no, for sure. So best places to reach out to me, either email, my first name, Matthias, M-A-T-T, followed by H-I-A-S at pioneercap.com, or my first name, last name on LinkedIn, I should come up. And then on Twitter, or X as it's called now, my handle is at SBA, Sam Bravo Alpha _ Matthias. And that's my Twitter profile where I try to post as frequently as possible.
Love it. All right, man. We'll appreciate the time. Everybody, thank you for listening. If you like this episode, please don't forget to rate 5 stars and subscribe. And we'll see you back for another episode next week.